Just about to kick off, so good timing. Our first panel is Show and Tell and why we invested in our portfolio. So we have a fantastic panel here today, and I'm going to introduce our fantastic moderator, Chris Gillings from 5V Capital. So if you want to give them a round of applause just to welcome them.
Thank you so much, and thank you all for joining us. My name's Chris Gillings. I am on the VC side of the house of a multi-asset management firm called 5V Capital, based in Sydney. The VC team, we focus on B2B software, which includes FinTech. So super thrilled to be here. Now, the good people at Intersekt have trusted 4 VCs to self-moderate today. We're not known for our brevity. So what I'm actually going to ask is, anyone sitting in the back row, you are also moderators today. If we are talking too long, if we're rambling, if we're talking our own book, polite arm up, just the back row, just to not embarrass anyone, but just a little wave, and we'll move on, or we'll take it as an opportunity to butt in and stop one of our fellow panelists from rambling too much. But look, really pleased to be here. As was mentioned, we're going to be talking about investments that we've made in FinTech. Some of them more recent, some of them a little while ago, but really try and delve into why we made those investments. But before we get started, I'm going to let my fellow moderator panelists introduce themselves.
I really only signed up to be a panelist, not also a moderator, Chris. Anyway, so I'm Amanda Angelini. I'm the managing partner at NAB Ventures. So we are National Australia Bank's CVC. The big red star, there's a big office that I was at yesterday. We are primarily strategic investors, so we're looking for emerging technologies, innovative companies to provide products and services for the benefit of our customers and our colleagues, and the entire team is down here in Melbourne, so feel free to say hello to everybody.
Hey everyone, my name's Raj Rayat. I'm an investor on the team at AirTree. We're a early to growth stage venture fund based up in Sydney. We recently raised a 650 mil fund that's sort of pointed at both sort of early stage, which is probably 2/3 of what we do, and also kind of growth stage software. And I guess kind of FinTech is a small but important part of our portfolio. We're about 125 companies across a range of different areas, predominantly software. And I think we have a grand total of 11 or 12 FinTechs as part of that. So mix of kind of payments, lending, traditional SaaS, and what you'd probably call RegTech as well. So yeah, excited to be here.
And hey everyone, I'm Ed from Square Peg. Been an investor there for about 6 years or so. I head up our growth stage investing at Square Peg. FinTech is a big part of that. About 1 in 3 of our dollars is in FinTech. Globally, that's across Australia, across Southeast Asia, and across Israel, and all across different areas of financial services as well, whether that's a SaaS business that's purporting to be FinTech all the way through to sort of credit-led models across Indonesia. So happy to chat about a bunch of different things today.
Alrighty, and just to recap, I work at a firm called 5V Capital. We have a private equity fund, some FinTech investments in there, so Fat Zebra would be one that a lot of you would know about. Then we have a growth fund, which is kind of a mix of venture-y, growthy private equity, and then I help lead the venture capital fund, which is Series A and B stage companies in B2B software, but sort of picks and shovels FinTech is included in there as well. So the topic for today is we're going to run through some of the portfolio companies that we've invested in within FinTech, why we did it. We're going to try and focus on at the point in time, as opposed to sort of let revisionist history tell us what has made them successful. And then we'd love to open up to questions. I think it's a pretty straightforward topic today, so we'd love to give plenty of time for questions at the end. Amanda, I might let you kick off.
Great. So I've got my timer. I've got 20 minutes. Awesome. Buckle up, everybody. 20 minutes of CVC. It's unheard of. So strategic investing. I like to think of us as venture capitalists with an added benefit. We're also able to provide strategic and commercial partnerships for the companies in which we invest. We're mostly stage agnostic, but what I also say, and people hear me say this often, is as a large financial institution, if we invest in something too early and we try and partner with something too early, sometimes things don't go according to plan. And so We in our team are very mindful of that. We're there to support the founders that we invest in, and sometimes our guidance is maybe we'll wait, we'll stay in touch, but we'll come in on the next round because that's actually going to be more beneficial. And we can do that because we're stage agnostic. And so I don't have different funds I need to slot things into. One of the benefits of balance sheet capital is it can be seed, it can be growth, and everything in between. It can be equity, it can be notes, it can be whatever format it needs to take. So I like to think of our team as well, just to give you a little bit of a flavour. We're both outside-facing into the ecosystem and meeting all of the great people that are at this conference. We are meeting with founders and their teams all of the time. And then we have to definitely be inward-facing into our institution. We are really good at our job if we know our company and we know our customers really well and we understand what pieces of technology and what companies are out there that are going to help and provide benefits to our customers. If we can marry those two things up, then that's a successful day for us. It doesn't mean that everything we've invested in is going to be an IPO unicorn, but it does mean that the companies that we do invest in, we're also a customer, and so we're providing revenue. So what do we look for? I will tell you, I'll give one example to start with. We invested in a company called Travata probably 3 years ago now. I was on the phone with the founder. He's in America this morning. And Travata is a real-time AI-enabled, so I said AI, Treasury management services startup. And I probably lost most of the audience where I said Treasury management services. However, if you're in a Treasury department or a finance department and you're doing forecasting or you're just doing your regular financials, monthly, quarterly, etc., most of the time you're sitting there with a bunch of spreadsheets, you're building macros. It takes a lot of time, it's a lot of late nights. You go to the meeting and then somebody really senior says, oh, well, what would it look like if you did this? And you go, oh, okay, well, I'll go back and I'll run that and I'll build some more macros, etc. Enter Travata. Travata powers what we call our NAB Liquidity Plus product. So therefore, successful partnership. We've married a big company with a nimble startup and we've created a market-leading product. It allows finance departments, treasury teams to generate real-time financials, forecasting, etc., that they can sit in a meeting and make adjustments on the fly. It is generated in real time. It takes seconds. There is a payments layer built into it. And as a payments and FinTech nerd, I get excited about this. And what also attracted us to this company was the founder. So we spend a lot of time with founders. Team is very, very important. And Chris is going to cut me off. I can see him picking up his microphone.
There were no hands, just to be clear.
Team is very important. The gentleman who started this company is so passionate about treasury management services. It's quite astounding. But he's passionate today when I spoke to him as much or if more so than he was 3 or 4 years ago. And so that makes a big difference for us. We obviously look at the tech, the team, market opportunity. We're global investors. This company is global. They're in the US, Australia, and in Europe. We do the same financial analysis. So yes, we are looking to make a return where possible. We're investors and we're managing capital. And then we are there to support them. We've helped them find staff in Australia as they've expanded out here. And that's one of the ones that we're very proud of. And I can stop there.
No, I actually had a couple of follow-up questions, but I'll let Raj take the stage.
Yeah, sure. Thanks, Chris. So yeah, just briefly on AirTree. So we've been around for about 12 years. I guess AirTree was really started because our founders sort of observed that there were sort of really world-class software companies being started in sort of Surrey Hills and Melbourne and other parts of the region. And the philosophy was really to kind of be early investors in those companies, wrap around them the sort of expertise, knowledge, experience that they need, and really kind of help them to go on to sort of tackle big global markets, and hopefully when it works to become sort of big sort of category leading companies. And we've been fortunate over the years to have some sort of success at doing that, which is great. And like I was saying before, FinTech is a sort of small but important part of our portfolio. And so sort of a bunch of companies in there, from sort of payments, companies like Zepto, lending, Athena, Bright, Prosper, and sort of more SaaS. But maybe I can talk about sort of one example on the sort of banking SaaS side, a company called Constantinople. AirTree was one of the first investors, along with our friends at Square Peg a couple of years ago. The business has since gone on to raise, I think it's 60 mil. We sort of raised a Series B late last year. And the Constantinople provides turnkey sort of banking as a software, banking as a service, software for really tier 2 mutual banks and also fintechs. And so the idea is that banks spend a ton of their sort of resources on operational and compliance sort of costs, a lot of headcount. And in today's sort of day and age, with both software and AI, the thesis is that you can kind of automate a lot of that work and help banks become significantly more efficient. And I'd say the problem is, certainly felt by our friends that sort of in the big four like NAB, but the problem is much more acute for sort of tier 2 and below banks who really struggle to have the capital to make the sort of transformation that they need to sort of become more efficient. And so Constantinople's signed their first few deals and sort of been growing really well. And I think what really attracted us to the investment was, one, the sort of thesis and the timing. It was quite unique proposition in market. And I think it remains so today. But more importantly, the team. Mac and Di, the two founders, were sort of career bankers. They had sort of spent some time at Westpac's digital bank and were sort of very experienced and mature operators. And they've gone on to basically build a bank within 18 months, which is sort of unheard of, I think, anywhere in the world. We're sort of scrambling to find other examples where that's happened, but really impressive. So maybe I'll sort of keep it very brief and pause there.
Shall I take the mic? So I assumed we'd run out of time by the time it got to me, so I'm going to cheat a little bit and rather than talk about one company, I'm going to talk about 5, but very sort of quick fire hopefully. So maybe to start off with, sort of the context I'm speaking from is, as Square Peg, we're investing in seed, we're investing in growth stage, and we've also got a public markets team. And in all 3 of those categories, we look very deeply into FinTech. So businesses like Zello, where we've backed them 3 times, Credivo, who are the leading consumer buy now, pay later in Indonesia, we've backed 6 times, Airwallex, who we've backed 8 times now. And the consistent theme in FinTech is no different to anything else. Sorry to make it a brilliant glimpse of the obvious. It's team. And so when we look at our investment decisions, it's very much a founder-led thesis, whether it's FinTech, whether it's SaaS, whether it's AI. It's around incredible curiosity, surrounding yourself with great people, and it's around how deeply do you actually understand the problem that you're going after and trying to solve. So everything else we look at really flows from that, and that's true whether we're looking at a seed investment. So when we first met Ben and Dom at Zello, which was called New Payments Company at the time, NPC, and their enthusiasm, their curiosity, and their understanding the problem they're solving in payments. And it's just as true when we were looking at Peter at Adyen, who founded the business back in the mid-2000s, and we invested through the public markets into that one. Now, naturally, as a company evolves, we look at a few different things on top of team. We think about people and culture. So I'd say that's broader than just the founding team. We think more about surrounding yourself with those sort of great talent. How does that really expand and flow throughout the rest of the organization? We care a bit more deeply around the moat, what you're building there, the moat trajectory, and deeply understanding that business model, how it expands, and your right to win over time. But all of that is still very much comes back to that foundational base of a founder-led business. Now, I did mention I'll try and go through a few quick fire takeaways of the problem to be solved and the unique insights of a few of the businesses we've invested in. Hopefully, some will resonate for folks in the audience. I will chat briefly about Constantinople. I know we've heard a little bit on that today, but I think the thing that really inspired us when we first met Mac and Di was their unique insight around the gunk that is not solved by tech vendors. They spent years building a digital bank at Westpac, chatting to tech vendors who could do 95% of the tech, but 50% of the work. And it meant that the bank had to do a bunch of work internally to actually get this tech working. And so the unique insight was, okay, how do we actually stitch this together so we can get to a 100% solution? And there's a massive tailwind here, which is product and services are now this big amorphous blob with AI, where you can deliver services like they were a product. And so they can take customer support operations, they can take all your financial reporting, they can do that on your behalf, and they can actually do an end-to-end product. It's very different to the others that are in the market today, and that was a really unique insight. Similar to what Raj said, we struggle to find others that are doing it in this way today, globally, not just in the Australian market. Take Airwallex. They've now scaled to be sort of a global first, digital first bank for any enterprise. But that's not where they started. That wasn't unique insight that started them off. They started very much on this understanding of if you are a high volume, low value transaction, you are getting the worst possible FX rates. It doesn't, if you're transferring millions of dollars overseas, it's fine. Banks can manage that. If you're trying to sell something for $10 overseas, you're getting terrible FX rates. And so how do we solve that? Okay, well, let's actually get a license ourselves and start doing it. And then on top of those rails, they've built out a bunch of different products and services, which is what you see today. But there was that core insight there on FX that really led them to build out. And the last ones that I'll speak to, and I said I'd be quick, which I haven't been, so apologies, is Adyen. Peter, when he first founded that, it was a PSP business that he sold to RBS back in sort of early 2000s. And they got acquired by RBS, and RBS basically stifled their whole product. And it was part of this strategy of payments businesses back in the day and payments technology back in the day where something new would come up around fraud and you'd buy something as a bank and say, I'm going to stitch it into my current platform, and you get this Frankenstein's monster of payments. And they realized this was just the way payments is going to evolve, is that more things need to get solved and you're going to acquire it and you're going to try not to build it from scratch. And as a result, you get this absolute gunk around a payments orchestration infrastructure. And so their insight was twofold. One was, okay, if we build payments from the ground up, we can do this in a materially better way with an architecture that's actually going to scale and allow us to tack on new things as they come. That's allowed them to do POS and a bunch of the offline sort of card present processing they now do today. The second thing was they were incredibly focused on which segments the pain is the greatest in. And so travel and airlines were their two core customer groups, and that served them for the first 10 years of their journey. So a material amount of their journey was actually in just two segments they were focusing on, and they had the blinkers on to really, really focus down on those. So I think just if I summarize that, across each of them, they're all different stories, but I think the founders had a deep understanding of that true problem that they were trying to solve, and mixed into that, they had a burning understanding of where the need was for their first customers, and really doubled down on that. And similar to sort of Mac and Di today at Constantinople, who are really, really focused on their first anchor customers and how do we really deliver for them, because we know that's the pain's the greatest, and then we know that there's a big market for us after that if we do this one really well. I'll pause there because I've gone way over after saying I wouldn't.
I'm going to show you how to do this in 1 minute. But everyone, we'd love some questions, so if the mic folks can sort of get ready to go, and if you do have a question, watch me do this in a minute. So business called Open Insurance, so does white labeled insurance as a service, largely partnering with much larger companies with a trusted customer base which allows them to offer insurance products across car, general insurance, phone insurance, you name it, and they basically power that super capital light model. So in terms of what was appealing to us, they run the tech stack. They're not the underwriter. They partner with the underwriter to power that. So it's sort of a three-way relationship between the brand, Open, and the underwriter. What we also liked about them is they didn't actually start that way. So they have their own brand themselves, Huddled. Some of you might use it for car insurance. They use that as a test bed to figure out exactly like what does the best-in-class product look like that they could then roll out in a more scalable way. We love that partnership model. The partnership model basically means it's like zero CAC for every additional customer that they brought on by partnering with these much larger, more powerful brands that already have the brand confidence from the customer base. And so it has been a super, frankly, stress-free investment for us. We invested a couple of years ago now, and they've just continued to add brands, which in turn has just had this compounding effect in terms of the business, done it in a super capital light way, and grown to be a very big business, and it's very much the market leader in that space in Australia, and has started to make inroads into other markets. 1 minute and 10 seconds. First question.
Hello, so my name is Piro. My question is more related to Amanda. So I'm aware as a corporate VC, as you mentioned, you invest in startups that will potentially become clients of NAB in that case. How do you manage the integration of that, the agility of the startup and so on, with the, in many cases, sometimes the slow process of corporate and so on? Like, is there anything that you do with that to ensure that a smooth transition and so on?
I spend a lot of time on the phone with both sides. I do, but so we try and make sure we keep a kind of very church and state thing around how we invest and those partnerships. So as an investing team, we don't get involved in the commercial negotiations, but we do help, and often we'll also get our innovation team involved, who are very much used to doing POCs and pilots and things like that. And so often we'll team up the business, the innovation team, and then whoever it is from our team to get people to understand how this process can be done in a more nimble way, and then stay on top of people so that we're sort of assuring that happens. Things sometimes get stuck. But again, if you've got the right people, the one thing that we do on all of our investments is we must have an executive sponsor. And so if you've ever worked with a large organisation, it doesn't have to be a bank. You definitely need buy-in from the business person. And frankly, if you can have somebody at a particular level whose name is also responsible for that integration, it's very helpful.
Up the back.
With all the noise and activity around the AI and agentic space at the moment, are you looking any differently at those opportunities from a unit economics perspective or a team perspective versus a traditional SaaS business?
I can take a crack at that. Yeah, you raise a really interesting point. I would say the answer is sort of yes and sort of no. In a lot of ways, these businesses share the same characteristics. I think the investment process is very similar in sort of understanding the customer pain point, what you can really solve, like whether there's a pressing need there, whether there's a kind of shift in the market that's going to sort of bring a lot of customers forward and drive a lot of growth. All those principles remain the same. I think that what's changed is that sort of because of AI, software is increasingly sort of doing the jobs of people. It's increasingly sort of automating service type workflows. And as part of that, the unit economics, as you mentioned, sort of change a little bit. And we're all kind of figuring this out as we go a little bit. Everyone's sort of making bets. I think broadly, I think what will happen with a lot of sort of software companies in this area, sort of agentic stuff, is there will be some that really kind of break out, have extreme sort of pricing power advantages, and I'm talking purely at the application level space, and look a lot like the best software companies with sort of 80% gross margins. And I think there will be a whole kind of universe of them which kind of fail to either achieve the pricing power they need or are really just kind of operating kind of very intensive, token-heavy workflows that will look a bit like this kind of wave of software. There's a lot of publicly listed software companies that sort of run at 50, 60% gross margins, which have a very kind of human customer service type overhead. But I think there will be certainly companies that sort of end up looking a bit like those. So yeah, we're also figuring it out as we go, but I think I'm sort of probably more optimistic than potentially the average there.
I think one of the things that's specific to FinTech that maybe is a little bit of a wild card is that the thing with these models is that they're non-deterministic, right? And so a lot of the companies that are coming to us that are newer and we're saying, we're AI first, we're using these LLMs and blah, 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 blah. But in some instances, they're solving problems that actually could have just been solved in the old way of doing things. So loan underwriting as an example, yes, you can definitely use LLMs to process documents quicker or maybe do unique types of underwriting, but sometimes the older way of doing things, at least as we sit here today, is actually where a deterministic set process decisioning, yes, no, state decisioning is better. And so part of our job as investors is to sort of pass through the noise of yes, are we overwhelmingly excited and probably to a flaw about AI opportunities? Not every company at this point can necessarily get as much value from this new wave of sort of LLM style AI. So trick for young players is that you just don't want to like just slap AI in the pitch deck or start to adopt or layer in AI for the sake of AI. I think that's particularly relevant in a lot of areas of FinTech where maybe the older way of doing things at the core is probably still the best way to do it.
I think that's fair to say. I will add though, the market size for FinTech is just materially expanded. Like what you could do yesterday versus what you can do today is materially different. Services are now products, and like we're seeing this in our portfolio already. The types of services they're now able to offer as products basically overnight is phenomenal. And so I'm much more bullish on like the size of the FinTech market today than I was even 2 years ago. And if I'm sitting here again in 2 years, I would expect to say the same thing once again, frankly.
Yeah, all the companies you all mentioned are B2B companies. Is there any B2C companies example? And is there any difference in the process for you when looking at a B2C versus a B2B company?
So happy to chat about Credivo. They're the leading consumer FinTech in Indonesia. They've got about 15 million customers today. And I would say that the quick answer is no, the longer answer is potentially over time. The quick answer being no is it's still very much that founder-led thesis. So it's like, do you really understand the problem you're solving? How are you solving it? Now, the specifics of that get more nuanced. So if I look at someone like Credivo, it's not about giving credit out, it's how do you get it back? And how do you build out the collections? What's unique insight around collections and underwriting in a market like Indonesia where there's a lot of opacity around credit decisioning. So it looks quite different, and the types of metrics we look at are different over time, and their moat looks quite different over time. But the fundamental thesis of like, what's the problem you're solving and how are you trying to solve it looks very, very similar.
We definitely look at B2C companies because we've got a whole group of consumer customers. So, and the same point, I mean, we look at them in a very similar way, but then unit metrics and et cetera are going to be different. And then obviously a partnership in that realm can look very different to what it would look like if we're looking at our B2B companies.
We're getting a very large, aggressive red light here. Are we done, or can we fit one more question in?
You'll probably fit one more question.
Alrighty.
There's one. Oh, yeah. Here's a microphone.
Second row.
Thank you for sharing your insights. The question is on red flags or pet peeves of why you didn't invest. So you might have loved a company, a founder, but you didn't go there because of X.
Why don't we do a quick fire round pet peeve, starting with Ed, and work down the line?
Calling revenue recurring when it's not. And it's not a red flag, but it's like, how do you really how do we understand this business and like really understand what are the key metrics actually driving this business and sort of where is that coming from? And so, and I'm speaking more, this is maybe less relevant in Australia. I don't know. I've spent sort of the last 4 years or so in Singapore focusing on Southeast Asian markets, and there that would be quite a continuous theme of trying to understand, okay, what actually are the key metrics driving this business? Is it annualized revenue, or is it a cohort-based business? And how do you think about it as a result? And how do you think about your CAC to LTV as a result? And what does that sort of infer about the size of this business and the progress you're making? So that's probably not a red flag, but a pet peeve personally.
Yeah, I'd say there's a million and one pet peeves, or I'd say a million and one ways to get a pitch wrong. There's an unlimited number of ways. I'd say one that I see really often is founders calling their TAM the sort of TAM for their whole market. Like, so if you're making logistics software, your TAM is not the total number of dollars that are spent in logistics every year. I just think it betrays perhaps maybe naivety or a lack of understanding about the sort of the market they're serving and the dynamics of that market.
Not to be hugely consistent, but I think the metrics one is probably something that comes up. We definitely spend a lot of time on the numbers, and obviously depending on what stage a company is, a seed stage versus a growth stage company, you get a lot of different metrics and different stages. But forecasts, so revenue forecasts and realistic forecasts, particularly when you get into the B2B realm versus the B2C realm, not building in sufficient time to get a partnership up and running with a large institution, regardless of whether it's an FI or a corporate, we find that often those time frames are shrunk down to a point that is possibly not realistic. Therefore, forecasting is not realistic.
My one's a simple one. I haven't talked about people today, so I'll say founders that are chasing after what is a big market but actually don't have a unique insight or a passion about that space. Particularly in FinTech is an enormous market. We'll often meet founders that are chasing that space or going after it just because of that fact, not because they've actually cracked the code on a unique insight or that they've spent 20 years in the trenches at NAB or MasterCard or in some other life where they've really learnt about a problem. And like Constantinople is a great example of those founders having been in the legacy tech of the larger businesses and really have that unique insight. And so just chasing after a market because it's big and not because you love it or because you know a lot about it is definitely my pet peeve. Thank you all for joining us. Hope you found it interesting, valuable. I think the team kept it pretty tight. So really appreciate you coming along. Please reach out to any of us if you'd like to have a chat about really anything, and have a great rest of your day.